You're welcome to yet another episode in our Forex bootcamp, and I'm glad to have you here once again. All right, so in today's video, we're going to be looking at terminologies in Forex trading. Okay, terminologies in Forex trading. It's kind of going to be a long video. Okay, so but I'll do my best to explain it briefly and clearly. Okay, so that you get to understand it in the simplest form. All right, so you agree with me that in every field of life there there are languages. Okay, there are terms, there are registers that are used specifically for this particular field. Okay, for example, when you come to a school setting, you talk about a classroom, you talk about the lecturer, you talk about students, you talk about notebooks, you talk about pen. Okay, so when you're saying these things, you know that you are referring to a school setting. Okay, so when you, for example, in the religious setting, when you talk about a church, okay, you talk about pastor, you talk about the members, the congregation, you talk about the Bible, you are referring to a particular, when you begin to use these words, you are referring to a particular field of study. Okay, you are referring to a particular field of life. All right, now, so the same thing applies in the Forex market, or the same thing applies to Forex trading. Now, we have terms and conditions that we use in Forex. There are terms and conditions Forex traders use to communicate. Okay, when you see this, when you hear or you see these terms and condition, it gives you a clue of what is being spoken about. All right, so we are going to be delving into each and every one of these terminologies, and I'll do my best to explain them to you. So in today's video, we are going to be employing a particular technique. All right, so right here I have my blank board. Okay, and I would be with time I will be referring back to this place to explain some things. All right, so first off, we have the PEEP. All right, the first terminology is called the PEEP, and PEEP is simply the short form of point in percentage. Okay, point in percentage. Now, point in percentage simply means the smallest price change in the currency market. Okay, usually 1/100 of a percent. It's also the basis of calculating profits and losses in the Forex trading, or in Forex trading. Now, I would explain this, okay, in the simplest form. Now, if you check, if you are conversant with some, okay, for example, let me say you want to measure the degree of hotness of a substance. Okay, you would make use of your thermometer. Okay, I'm sure most of us, or if not all of us, know what a thermometer means. Okay, a thermometer is an instrument that measures the degree of hotness of a substance in a unit. Okay, and the unit is called degree Celsius, sorry, degree Celsius. All right, so when you dip a thermometer into an hot object, it it increases the reading. Okay, let's say before you dipped the thermometer, it reads 100, or it reads 0 degrees Celsius, and then when you dipped it inside the hot object, it begins to elevate the reading. Okay, from zero, you now begin to get some, depending on how hot the substance is, you can now begin to get something above 0 degrees Celsius. Okay, so same thing applies to the Forex market. We measure the changes in price of the market in pips. Okay, we measure the changes in price in pips. Okay, so let's just go back to our drawing board, and let me give a good explanation. Now, in most cases, the most I would want you to note that the most traded currency pair is the euro USD. Okay, this is how it is often written. Okay, euro USD. This is the most traded currency pair. All right, so now, one thing I would want you to note is all right, let's just give me a minute. All right, yeah. So most times price come in form of decimal places. Okay, price come in decimal places. For example, let me just give a typical price a typical price level. Okay, let's say we have 1.02 1.026 1.0265. All right, 1.0265. Let's say we have, or most times it comes in five decimal places after a decimal point. Okay, it comes, there are always five decimal numbers after the decimal point. Okay, so let's assume that price moves. This is a particular price range. Now the peep is always a number before the last number, okay, after the decimal point. Now the last number after the decimal point is 1. Okay, now the number that comes before the last number after the decimal point is 5. Okay, now this 5 is now considered as our peep. Okay, this 5 is what we use to measure our peep. Now let's say price moved from 1.02651 to 1.02661. Okay, with this we can say price moved 1 peep above. All right, price moved 1 peep above. Now in considering the vice versa, if price moved from 1.02651 to 1.02641, then we'll say price moved 1 peep below. Okay, below the current below the previous price. Okay, so this is just the simple analogy of how peep is being calculated. Now I'll still give another illustration. For example, I told you that there are different currency pairs. Okay, there are different currency pairs. Let's say most times currency pairs that has the Japanese yen embedded with it kind of has a different setup, or a different number range. Okay, let me just explain what I mean. For example, we have something like USD JPY. USD JPY. Okay, USD is the United States dollar and JPY is for Japanese yen. So we have the United States dollar against the Japanese yen. Okay, now let's just look at let's just take a look. I told you the currency pairs that usually have the JPY, that's the Japanese yen, with it has a different setting. Okay, so most times they come in three decimal places before the point. Okay, the last example I gave was something like 1.02861 or something like that. Okay, but in this case, this is what we have. We'll have something like 1.24 point let's just say 0.046. Okay, now in this case we will still use the same concept to measure our pips. Our change in pip would be the number before the last number after the decimal point. Okay, the last number after the decimal point is 6. Okay, the number that comes before the last number after the decimal point is 4. So any change in pip would affect our figure 4. Okay, now let's say price moved from 124.046 to 124.026. All right, now we would say price moved 2 pips, 2 pips, 2 pips below the former price. Okay, price move just because when you minus 2 from 4, you get 2. Okay, that is how we got 2 pips. Okay, that's how we got 2 pips. Okay, so you say price moved 2 pips below. All right, I believe I have been able to do justice to this particular concept. It is actually very, very important to learn this. That is why I took time to explain it, because the peep concept affects every other aspect. Okay, because it is the basic unit of measurement. All right, of price changes. Now the next is spread. Now, spread is simply the difference between the bid and the ask price. All right. Now, what is a bid price? A bid price is the price that the buyer is willing to pay. Okay, for example, you want to buy a shoe, you go to the market and you have $20. All right, $20 is your bid price. Okay, you are willing to pay $20 for that shoe. So that is your bid price. Now, the ask price is simply the price the seller is willing to sell to you. All right. Now, if you want to get a shoe and you are hoping that that shoe is $20, and you get to the market and discover that the seller sells the shoe at a price of $30, that means your bid price is not equal to the ask price. So the implication is that you cannot get that shoe. Okay, until there is a correlation, until there is an agreement between the bid price and the ask price, that is when that is when an exchange can be done between the buyer and the seller. Okay, now this thing also applies to the forex market. Now, the difference between the bid price and the ask price is what is termed as spread. Okay, spread. Now, spread is often measured in pips. I told you pips is the basic unit of measurement. So spread is often measured in pips. Now let's just go back to our drawing board, where I gave an example of what a typical change in price looks like in pips. Now let's say 1.0264. Okay, and if price move from this 1.0264 to 1.0254, you agree with me that price moved one pip below the former price. Okay, now this aspect, this term called spread is it's actually what most brokers, okay, spread is what most brokers use as a commission. Okay, spread is a commission that you are being charged for. I mean you are being charged a commission in order to open a trade. Okay, just as I told you, your broker links you to the forex market, so definitely they will have their commission for linking you to the forex market. Okay, so that commission is called the spread. Okay, it's called the spread. It's just the difference between the ask and the bid price. Okay, now that actually gives you the spread. Okay, so the spread is the difference between the ask and the bid price, and it's also the commission that your broker charges you for opening a trade. Okay, that's by the way. So thirdly, we have leverage. Okay, leverage is more like or let me just define it from here, the use of borrowed capital in brackets or such as margin to increase the potential return of an investment. Leverage can amplify both gains and losses in the forex market. Okay, now, in the course of all right, I think I'll explain that later. So, but let me just do justice to this particular terminology. Leverage. Let's just say, for example, you want to um you want to go get something in the market, okay, and the money you have is not enough. Okay, let's just say you need to take transport from your house. You need to take transport from your house to the market. Now, the money you have is not enough, okay, to for transport. Okay, the money you have is not enough for transport. Meanwhile, you need to get this thing. All right. Now, let's say a neighbor of yours actually has the money for transport and also wants to get the same thing you want to get from the market. Now, giving your neighbor your money to help you purchase that thing in the market is more like you are leveraging on that opportunity. Okay, that's just a term. Leverage is more like taking advantage of. Okay, that's the simple meaning of leverage. You are taking advantage of something. Okay, now coming to the forex market, we retail traders are forex traders like me and you. Okay, individual traders that trade the forex market, we are mostly called, or we are called, the retail traders. All right, so most retail traders don't have enough capital power, okay, for you to actually open a standard amount in the forex market. I told you that the forex market is the most liquid market. okay, and it deals with a lot of money. More than $6 trillion is being pumped into the forex market on a daily basis. All right. Now, having $10 doesn't change anything in the market. It's just like pouring a cup of water in a very large ocean. Okay. It doesn't change anything. All right. So, what happens is that your broker gives you a very high amount of money. Okay. Now, leverage comes in ratios. Leverage comes in ratios. Now, when we're talking about leverage, we can it is expressed in ratios. Ratios like 1:500. Okay, we can have leverage like 1:500, 1:100. Okay, we can have 1:200. Okay, and so on and so forth. Now, what this means is that for every $1 that you have, okay, in your account, your broker provides $500. Okay, if your leverage is 1:500, okay, that means for every $1. So let's just say you funded your account with $10. Okay, that means what your trade is being presented as in the forex market is what your capital is being presented as in the forex market. Instead of $10, it is being presented as $5,000. Okay, it's being shown that you actually have $5,000 because without this you cannot trade the forex market. Okay, so your broker gives you more leverage. Okay, they give you that money, but it's not like you cannot withdraw that money. Okay, but you are just using that money to have an edge in the forex market. Okay, so that's I think that does that that does justice to the part of leverage. So next we are going to be talking about margin. Okay, margin is a deposit required to open or maintain a position. Okay, it is expressed as percentage of the position size, and it is necessary to keep a position open. Okay, now for every trade that is open, there is a required amount of money. That is there's a money there's a required amount of money that should be used to open that position and also maintain that position. Okay, now when that amount of money is not enough, okay, that's when your broker will begin to alert you and tell you that the money in your account is not enough to hold this position. You may need to reinforce, you may need to refund, or you may need to add up your money, okay, in order to enable you continue to hold this position. Okay, so that's simply what margin is. And when your broker begins to call you, draw your attention to the fact that your money is not able to hold a position, that is called margin call. Okay, margin call. We'll get to see that as we progress in this particular video. Now, up next we have lot size. Now, lot size, the standard unit the standard unit size of a transaction. Okay, one standard lot is equal to 1,000 units of the base currency. All right, now lot size simply means you see, in a there's actually a calculation to this. All right, there's actually a calculation to this, but I won't like to bore you with so many things, so many informations that you need. I am here to show you the basic things you need in forex markets. Okay, I'm not here for mathematics. I'm not here to teach you mathematics. I'm here to teach you forex. Okay, so now currently, or let me just explain this now. Lot size in the simplest form is a unit, is a standard unit for transaction that you can use to expose a certain percentage of your account. Okay, to let's just say for example and there are actually three types of lot sizes. We have standard lots, we have mini lots, and we have micro lots. Okay, standard lots is being measured in 100,000 units, okay, of the base pair. Okay, so for you to open a standard lot, okay, you need $100,000. Okay, that is what, coming back to what I told you before about leverage. All right, your broker gives you a leverage, an amount of money, okay, for you to open a particular trade. All right. So your broker, this naturally speaking, you are supposed to use 100,000 units of that particular um amount of money, or for that particular currency. Let's say we are dealing with the US dollars now. You need 100,000 US dollars in order to open one standard lot. Okay, and you cannot do that as a retail trader. With most retail traders don't have that money. Okay, that is where leverage comes in. Okay, that is where leverage comes in. That is where your broker now brings in a particular amount of money and equates it to $1 of your account, and this gives you the chance to enter trades. All right. So that being said, let's move on to the next point, which is long position. Now, a position that appreciates in value when the price of the base currency increases. Okay. Now, in forex markets, let me just give a little bit of explanation as regards to this. I told you we have something like Euro USD. Okay, we have something like Euro USD. Now, this is how a typical currency pair comes up. All right. Now, what happens is that the first pair, this particular currency, is called the base currency. Okay, it's called the base currency. Now, this particular currency is called the quote currency. Quote currency. All right, it is called the quote currency. All right, so now we have the base currency and we have the quote currency. Okay, when we're talking about now when we're talking about the let me just go back to our page. All right. Now, when we're talking about a long position, it talks about that a position that appreciates in value when the price of base currency increases. I told you we have. Oh, sorry about this. Now, I told you we have the base currency, which is the euro, and the quote currency, which is the USD. All right. Now, when this guy appreciates over this guy, we would say this is a long position. A long position simply means you are buying. Okay, that's simply what a long position means. Okay, sorry about that. I think there was just a little bit of technical issue. So as I was saying, a long position simply means buying. Okay, it just simply means you are buying a particular commodity. Okay, when long can also be called a buy position. Okay, when you want to buy a particular currency, for example, we say the euro is appreciating over the dollar. Okay, now I want to long the euro against the dollar, means I want to buy the euro against the dollar. I feel like the euro is going to appreciate more compared to the dollar. So I am longing that position. I am buying more of euros. Okay, in that case, we would say we are longing. Okay, we are taking a long position on euro USD. All right. Now, the vice versa applies to the short position. Okay, the short position is a position that appreciates in value when the price of the base currency decreases. Okay, now the base currency, as I simply referred to the last time, is the first currency. Okay, now let's say the euro and the USD. Okay, the euro against the USD. Now, once euro begins to depreciate and the US dollar begin to appreciate, would say that this guy, the euro guy, is shorting. Okay, is shorting against the US dollars. Okay, so in this case, would prefer to take a short position. Okay, would prefer to sell more of our euro because the USD is appreciating against the euro. Okay, so in this case, we are going to be having more like a down charts like this. When we go to our technical analysis, I'm going to explain more of this. Okay, I'm going to explain this more. So that's for the short. Then we have stop loss orders. Okay, stop loss is an order placed to limit losses if the price moves against a trade a trader's position. Okay, for example, let's just say I have $100. Okay, I funded my account with $100. Now I want to buy the Euro USD. Okay, I want to buy the Euro USD. I've done my analysis and I've predicted that the euro is going to rise against the United States dollar. Now, this is what happens. I will risk a particular amount of my capital in that trade. Okay, I can decide to risk like 1% of my capital in that trade. 1% of $100 is $1. Okay, so when I enter the trade, I will set a stop loss that will make sure that no loss will exceed $1 in that trade. Okay, that is why stop loss orders are very good and they are important. In fact, they are one of the, if not the most, they are the, in fact they are the most, let me put it like that, they are the most important order you need, okay, while trading. Because when you cannot limit the level or the amount of losses you are making, then you are bound to lose your account. Okay, so the same applies to take profit orders. And another thing is, when you set these stop loss orders, once you enter that particular trade, once price goes against you, let's say you are predicting that euro is going to rise against the dollar, and then euro begins to fall against the dollar, that means your predictions were wrong. Okay, now, and let's say price begins to go against you, now it goes to a particular level where you have placed your stop order, okay, your stop loss order. Now, once it hits your stop loss order, it takes you out of the market with that particular 1% loss, even if you are not there. Okay, so you don't actually have to keep monitoring your trades with your phone, and you just need to set your stop loss orders, and then you are good to go. Once the price goes against you, you are out of the market. Okay, and the same thing applies to the take profit order. Okay, the take profit order is an order placed to okay, lock in profits, right? Okay, let me just take it again. Take profit order is an order placed to lock in profits if the price reaches a certain level. Okay, just as I explained the stop loss order, the take profit order, for example, once I predict that the dollar is going to rise against the naira, okay, and dollar begins to rise massively against the naira, that means my predictions are right. Okay, now it gets to a level where dollar rises against the naira, and I would fix my particular take profits order there. Take profits means you are taking a profit out of the market. You are taking your profits out of the market. Okay. So once price gets to that level, it shuts you out with that particular profit you have made. Okay. So even after making that profit, let's say the price begins to go down against you again, it will not affect your money. It will not affect the profit you have made because you are already out of the market. Okay, you are out of the market with that particular profit. So this is one good thing about these orders. All right. So next up, we are going to be looking at currency pair. Okay. Now in currency pair, we have now the quotation and price structure of the currencies traded in the forex market. Okay, the value of a currency is determined by its comparison to another currency. Okay, I think I've explained this. All right. So as I said, we have currencies. Currency comes in pairs. Okay, currency is being analyzed relative to another particular currency. Just like we say, we have the dollar against the naira. The dollar is rising against the naira. Okay, now what we are saying is that we are comparing two currencies. Okay, this currency comes in pair. All right, so let's go back to our drawing board. Now currency comes in pair. Something like this. This is a typical currency. I keep using Euro USD because this is the most traded pair. Okay, so now we have the Euro USD. Okay, now if the euro rises against the dollar, okay, we would say that euro is appreciating or is longing against the US dollar. All right, now euro is the base currency. Okay, euro is the base currency and USD is the quote currency. Okay, USD is the quote currency. So once the base currency is rising above the quote currency, we will say this particular pair is appreciating, this particular pair is longing, okay, and vice versa. Once the euro is going against the USD or the USD is going above the euro, we would say this particular pair is shorting. Okay, so that is that for that. All right, so let's just move on to the next. We have the base currency, the first currency listed in a currency pair. Okay, I've explained that. It is also known as the transaction currency. All right, so take note of that. Then we have the quote currency. Okay, the second currency listed in a currency pair. It is also known as the counter currency or the price currency. All right, so then we'll move to market order. Okay, now market order is an order that buys or sell a financial instrument, okay, immediately at the current market price. Okay, now we have different type of market orders. Okay, we have execution order, we have the limit orders, and we have the stop orders. Okay, now we have the execution order is immediate market execution. For example, I want to sell the euro USD. Okay, using an execution order. Okay, once I just get to the market, I am selling instantly, irrespective of where market price is. I will just sell instantly. So I am executing that order immediately. Okay, so that is the execution order or the market order. Now we have the limit order. Okay, the limit order is an order placed to buy or sell at a specific price, okay, or better. All right, now let's say price is below a particular or let's just say price is at a particular point. Now I want to sell. Okay, now I want to place a limit order. Let's say I want to place a sell limit order. I would put my price at a particular level above where price is, so that when price gets to that level, it begins to sell from there. Okay, limit means like when we talk about limit, we are talking about restriction. Okay, we are talking about restriction. Let's say market is at a particular price. Okay, now I want to sell this market. Now the market keeps buying, and I want to place a sell limit order. What I am simply saying in layman English is that one price will not buy above this particular limit. Okay, so I put a sell limit there, okay, against that buy in price. So I'm predicting that once price gets to that particular place, okay, once price change, or once price rises to that particular place, it will not exceed that limit in price, okay, where I set my limit order. So it begins to go down, it will begin to sell. Okay, so definitely we'll get to see these things practically once we get to the practical session. Okay, so next we have the bid price. Okay, the bid price, as I explained, is the price at which a market maker is willing or wants to buy, is willing to buy a particular currency pair from you. Okay, bid price is simply the price that a buyer wants to buy from a seller, and ask price is the price at which a market maker is willing to sell a currency to you. Okay, so I believe that is just a basic um, definition, and I've explained that before. So we have the currency codes. Now, three-letter codes used to identify currencies in the in the forex market. Okay, now for example, we have the USD. Okay, these are codes that you use to identify specific currencies. Okay, for example, when you come to a chart and you see the USD, you should know that they are referring to the United States dollars or the US dollars. When you see EUR, it means the euro. When you see JPY, it means the Japanese yen. When you see GBP, you are talking about the British pound. When you see AUD, you are talking about Australian dollars. When you see CHF, you are talking about the Swiss francs, okay, the currency that is being used in Switzerland. Then when you talk about CAD, which is the card, we are talking about the Canadian dollars, okay. So these are codes that we use to identify particular currencies that are unique to specific country or specific geographical area. Okay, now we have the swap. All right, now the swap is the cost or the reward associated with holding a position overnight. Okay, it's usually expressed in pips, okay, which is the unit of measurement in of change in price. Okay, now the swap, let's say you hold a position, you entered a trade, euro USD, you bought the euro against the USD. Now and then you want to leave that particular trade, that buy trade, for more than a day. Okay, there would be a particular commission, there would be a particular a cost, there will be a particular price that you will be charged, okay, for leaving that trade for the whole of that day, okay, to the next day. Okay, now that is called a swap. Now, one thing you need to know about a swap is that it's more like it fluctuates. Okay, it can go in your favor, it can go against you. Okay, you can there's I feel like when we get to the practical session, we will tend to understand these things the more. Okay, so a swap is more like the price that you are being charged for holding a position overnight. Okay, for holding a position for more than 24 hours. All right, so let's move to our next and last terminology. um Now, our last terminology is the margin call. Okay, margin call is a notification from a broker that more funds are required to cover the potential losses on a position. Now, you agree with me, at the beginning part of this video, I talked about margin. Okay, I talked about margin. Now, a margin is the minimum amount of money required in order to open or to to hold a position. Okay. Now, when that money it is when the money you are using to hold a position is no longer let's say is no longer enough, is no longer sufficient, your broker begins to notify you. Your broker begins to alert you that um you have to do something about this. You have to add more funds, okay, in order to keep holding this position. That is what is called margin call. So whenever your broker calls you to tell you that a particular position is still ongoing and there is not enough money to keep this position going, they call your attention, and the process of calling you is referred to as margin call. All right, so this would be the last terminology we're going to be looking at. Definitely, we cannot exhaust the whole terminologies in Forex, but I just picked the major ones to talk to you about it, because these are the ones you get to encounter on a daily basis throughout your trading career. So that will be all for this video. It's been a lengthy one. Trust me, it's been a lengthy one, and I believe you were able to get value from this video. All right, thank you so much.